China's economy is in a serious recession, with waves of collapse, bankruptcy, and unemployment spreading to the banking sector. Since the beginning of this year, more than 50 banks in China have gone bankrupt, and nearly 1,500 bank branches across the country have closed. Economists and analysts warn that a financial tsunami in China may be imminent, and more bank failures and collapses are inevitable in the near future. According to the latest data released by the State Administration of Financial Supervision of the Communist Party of China, at least 50 small and medium-sized banks have been dissolved this year, the vast majority of which are rural small and medium-sized banks. At the same time, the wave of mergers and reorganizations of small and medium-sized banks has accelerated. For instance, Liaoning Rural Commercial Bank absorbed and merged 36 rural small and medium-sized banks, while Shenyang Rural Commercial Bank merged with 30 rural credit cooperatives. Experts believe that China's economy is in severe recession, and bank bankruptcies, mergers, and reorganizations are the general trend. Xi'an, a professor at the University of South Carolina, said, "It is quite serious that so many banks are closing at the same time. The reason is obviously that the entire Chinese economy is in a severe recession, and even the financing activities and financial activities of real enterprises are declining, resulting in decreased bank profits, bad debts, abnormal capital flows, or shortages of funds, and significant losses." Experts predict that more small and medium-sized banks may fail and close down in the future. Xi'an also stated, "Because we see that China's original troika of driving forces for economic development, or the current so-called new productivity to promote economic driving forces, seems difficult to effectively stimulate the economy, China's economic recession may continue. Over time, more banks may face the same risk of failure." According to incomplete statistics from the State Administration of Financial Supervision of the Communist Party of China, as of July 25th, nearly 1,500 bank branches have been closed, including major state-owned banks, city commercial banks, and rural commercial banks. In 2023 and 2022, 2,756 and 2,383 Chinese commercial bank branches were closed, respectively. Analysis points out that behind the wave of bank failures is usually an impending financial tsunami. Taiwanese economist Huang Shichong said, "If the country's banks cannot operate, it also means that the country's economy has very big problems, including a sluggish banking industry, a sluggish real estate industry, sluggish corporate loans, and sluggish private consumption." Similar financial turmoil has occurred in Europe, the United States, and Taiwan. They have allowed it to collapse and then merged to quickly heal the wounds and stop the bleeding. However, the CCP's strategy is to wait for changes, so there may be more Chinese bank collapses in the future. China's economy in a deeper quagmire than Japan's in the 1990s. The latest data shows that China's economy is still in a deep quagmire, with various stimulus policies from Zhongnanhai failing, and the country officially entering a balance sheet recession. Lu Ting, chief economist at Nomura Securities, commented that the environment facing China will be more difficult than that of Japan in the 1990s. According to Chinese statistics, in the second quarter, foreign direct investment, FDI liabilities, decreased by nearly $15 billion. This is the second time this figure has turned negative. The previous instance was during the Asian financial crisis in 1997, and the outflow amount was also higher than the $12.1 billion recorded in the third quarter of last year. Assessing the turning point, in early 2022, when the CCP locked down Shanghai, foreign direct investment began to decline sharply and has not recovered since. The sharp decline in new loans shows that the vast majority of Chinese companies have become flat, unwilling or afraid to borrow to invest. The Social Financing Scale report released by the People's Bank of China last week showed that new loans were 260 billion yuan in July, down nearly 88% from the previous month, and far below the 450 billion yuan expected by analysts polled by Reuters. This is only about 1/10 of normal months, and the decline can be described as dramatic. Moreover, The People's Bank of China released cumulative data from January to July this time. Many data points do not include separate monthly figures for July and need to be calculated separately. According to Reuters calculations, household loans, mainly home mortgages, fell sharply by 210 billion yuan in July, while rising by 570.9 billion yuan in June. Corporate loans fell directly to 130 billion yuan from 1.63 trillion yuan in June. The official explanation given by the CCP is to squeeze out water, meaning the difference is caused by statistical magnitude. However, looking at the direct M1 of individuals and enterprises, the M1 balance fell 6.6% year-on-year, and the growth rate is still negative. At the end of last month, it was down 5% year-on-year. M2 increased by 6.2% year-on-year, which shows that most companies and individuals prefer to convert their current deposits into time deposits or financial management, rather than investment or consumption. This is a typical flat collective. Since July, more companies and individuals have begun to transfer their deposits into financial management and purchasing, greatly increasing the price of government bonds. This will increase China's financial risks because the corresponding government bond interest rates for the central bank, the increase in long-term interest rates, and government bond prices will lead to a decrease in long-term interest rates and the risk of yield inversion. This makes the CCP very concerned. The method calls for a direct ban on rural commercial banks, securities companies, etc., from conducting government bond transactions. However, it is obvious that it is not working well. Total social capital decreased in July, marking a major turning point in the decline of the balance sheet. Last year, Japanese economist Ku Xiaoming proposed a theory of balance sheet recession based on Japan's 30 lost years, which has aroused widespread concern in the Chinese government, industry, and academia. He pointed out that the cause of this recession is high debt in the private sector, which often causes individuals or companies to repay debt first to increase savings instead of consumption or investment, which in turn leads to economic growth slowing down or declining, and eventually an economic recession. Since last year, Chinese scholars have generally believed that, unlike Japan, there is no such thing as a balance sheet recession. The first 7 months of this year saw total social financing of 18.87 trillion yuan, a sharp decline of 3.22 trillion yuan compared to the same period last year, down 14.6%. Looking at the month, new RMB loans in July were 260 billion yuan, down 85.9 billion yuan from 345.9 billion yuan in the same period in 2023. This is the first decline since July 2005. So the economic community has once again begun to debate, has the Chinese economy entered the model of Japan's Great Recession in the 1990s? 8 banks vanish daily, millions in salaries reclaimed, savings vanish.
又一家银行停业公告。
Announcement of termination of business of China Guangfa Bank at Yifang Branch, Dongcheng District, Dongguan. This trend is not rare these days. This year is very hard for the common citizens. If banks are like this, then how can we survive in this nation? Another bank announced its closure. In the current market environment, it is difficult for banks to continue to operate. The banks are closed down one by one. Do you think business will be good in 2024? China's banking sectors are facing unprecedented challenges, reflecting broader economic issues within the country. Once considered a symbol of stability and prestige, jobs in the banking industry are now under increasing pressure. Many banks are laying off staff, particularly outsourced employees, and cutting salaries. This shift marks a significant change from just 2 decades ago when securing a bank job was highly sought after, offering good pay, great benefits, and social status. Today, bank employees often work long hours for reduced pay, and job security is no longer guaranteed. The banking industry is prone to driving bankers to the brink of insanity, primarily because it expects results without providing the necessary support. This year, the phrase "bankers quitting" has almost become a trending headline in banking articles due to mounting pressures and nearly unachievable targets. Recently, a netizen from Anhui shared the management system of a certain bank, revealing that all regulations are essentially ways to deduct employees' salaries, with fines ranging from 50 to 10 units. Most notably, this bank refers to these deductions as their source of happiness. As one netizen remarked, this is a real-life example of building one's happiness on the suffering of others. For instance, reading unrelated books results in a 10-unit deduction, as does reading specific books. The most astonishing part is that not only are salaries decreasing, but there is also a possibility that your salary might be reclaimed. Therefore, the money that reaches your pocket may not actually be yours. Let's start with the bank branch closures. In the first 5 months of 2024 alone, 1,257 banking branches shut their doors. That's a staggering 30% increase from the previous year. To put this into perspective, it means that every single day, about 8 bank branches are closing across China. If we extrapolate this trend for the entire year, we could be looking at over 3,000 branch closures by December. This is not just a minor adjustment, it's a massive contraction of the banking sector that could leave millions of Chinese citizens without easy access to banking services. I've been notified of a credit limit reduction. Some people's salary cards have reportedly been reduced to as low as 50 yuan, with some claiming it's not even enough to pay rent. What's going on here? Some netizens have reported that a few days ago, one of their clients was stunned while processing a property transfer. When the buyer tried to transfer the down payment to the seller, they realized their transfer limit was insufficient. This home buying client stated that their transfer limit had always been normal before, but now it has been reduced. Another netizen reported that withdrawing 20,000 yuan, about $27.50 USD now, requires reporting to the local police station. They have to wait for the police to check their account before they can withdraw money. What's going on here? Why are banks quietly imposing limits on account holders based on their original transfer limits? Some netizens have stated that transferring money to their own family members, such as parents or spouses, is now restricted and they can't transfer funds. One user commented, "Is it necessary to plug everyone's anus in the village to prevent someone from defecating in public? They can't understand it. How is money flowing overseas being transferred out? How is money for skin betting being transferred out? What should be restricted isn't being prevented, and what should be prevented isn't being stopped." During my probation period, I received a salary of 2,400 yuan, about 330 USD, but it was put under control by the bank. Here's what happened after working at the company for half a month. I received my salary and planned to use it, only to find that I couldn't withdraw any of it. The balance showed the amount was there, but I couldn't access it. After calling customer service, I learned that my funds were being held for control and that I needed to visit the branch to resolve the issue. When I went to the branch, the staff explained that it was a fraud prevention measure by the bank system, which held my balance. They told me to apply online for the remitter to help verify the transaction. It was frustrating. I also contacted the HR department of my previous company, but they were unwilling to help, stating that similar situations had always been resolved by communicating with the bank. Fed up, I explained the issue to the bank's official customer service and filed a complaint. The next day, a dedicated staff member called me, asked for the basic details, and said it would take a few business days to resolve. To my surprise, the control was lifted on the same day. It's quite frustrating. If I had urgently needed the money, the bank's handling of the situation could have been disastrous. The reverse salary demands implemented by banks are another clear indicator of the desperation gripping the sector. 11 listed banks have already recovered nearly 100 million yuan, about 14 million USD, from their employees. China Merchants Bank alone clawed back 43.29 million yuan, about 6 million USD, from 4,415 employees in 2023. That's an average of 9,800 yuan, about 1,350 USD per affected employee, a significant sum that could represent a month's salary or more for many workers. These days, bank employees have experienced salary cuts, with some discovering that their take-home pay is less than 10 yuan. What was once a golden rice bowl has now fallen from grace. Previously, banks typically paid monthly salaries exceeding 10,000 yuan, about 1,400 USD, and some executives even earned annual salaries in the millions. The job was also stable, with a 9-to-5 schedule. However, bank jobs have not only seen salary cuts but have also faced reverse salary recoveries. Last year, 7 banks sought to recover over 500,000 yuan, about 69,000 USD, from employees. The pressure of KPIs in banks has also increased, with fresh graduates entering bank jobs bearing annual deposit targets of 300,000 yuan, about 41300 USD. In April, the increase in social financing was negative 198.7 billion yuan, about 27 billion USD, compared to over 1 trillion yuan, about 138 billion USD last year. This indicates that businesses are unwilling to take loans, making it difficult for banks to lend money. Since banks primarily make money by lending, if they can't lend, their income will inevitably decline. Among the 42 listed banks last year, 31 saw a decrease in per capita revenue. But here's the truly alarming part: over 95% of Chinese banking institutions have now implemented these reverse salary collection systems. If this practice spreads to all banks and continues at the current rate, we could be looking at billions of yuan being taken back from bank employees across the country. This is not just a financial issue, it's a social one that could lead to widespread discontent and unrest among banking sector employees. The profitability of banks is also in free fall. Zhejiang Bank's forecast of a 30% decrease in net profit for 2023 is likely just the beginning. If other banks are experiencing similar drops but not disclosing them, the true state of the banking sector could be far worse than what's being reported. This raises serious questions about the stability of the entire financial system. The wave of bank mergers and reorganizations is another red flag. In just the first half of 2024, more than 80 small and medium-sized banks underwent mergers or reorganizations, with over 40 in June alone. That's more than one bank restructuring every single day. This frantic pace suggests a desperate attempt to prevent widespread bank failures. If this trend continues, we could see hundreds of banks disappear or be absorbed by larger institutions by the end of the year, fundamentally altering the banking landscape in China. Now let's consider how this banking crisis is intertwined with the real estate market collapse. The 46.8% year-on-year drop in sales volumes for the top 100 real estate companies in the first 4 months of 2024 is nothing short of catastrophic. This isn't a slowdown, it's a market in free fall. Even state-owned companies, which typically have more resources to weather economic storms, saw sales plummet by over 30%. This suggests that the entire real estate sector, regardless of ownership structure, is in serious trouble. The inventory of unsold commercial housing has reached a mind-boggling 746 million square meters. To visualize this, imagine 7.46 million average-sized apartments sitting empty across China. That's equivalent to entire ghost cities going unoccupied. This massive oversupply could take years, if not decades, to clear, even if demand were to suddenly spike, which seems unlikely given the current economic climate. The debt situation for real estate companies is equally alarming. With 770 billion yuan, about 106 billion USD in bonds maturing in 2024, these companies are staring down a debt cliff that makes the 2008 financial crisis look like a minor hiccup. This amount is roughly equivalent to the GDP of a small country. If even a fraction of these companies default, it could trigger a domino effect that would ripple through the entire Chinese financial system and beyond. The vicious cycle between the banking crisis and the real estate downturn is particularly worrying. As property developers struggle to sell homes and repay loans, banks are left holding an increasing number of non-performing loans. This makes banks even more reluctant to lend, further starving the real estate market of needed capital. It's a downward spiral that seems to be accelerating with each passing month. Public sentiment is turning increasingly negative, with Chinese netizens openly questioning the disconnect between falling wages and rising prices. This growing distrust in the economy could lead to decreased consumer spending, further exacerbating the economic downturn. When we look at all these factors together, thousands of bank branches closing, billions in salary clawbacks, real estate sales cut in half, millions of unsold properties, and hundreds of billions in looming debt, the picture that emerges is of an economy not just in trouble, but on the brink of collapse. If these trends continue or worsen, we could be looking at a scenario where major banks fail, potentially wiping out the savings of millions of Chinese citizens. Real estate developers default en masse, leaving countless unfinished projects and homeowners in limbo. Millions of Chinese find themselves with mortgages worth far more than their properties, leading to widespread negative equity. Unemployment skyrockets as both the banking and real estate sectors shed jobs, with ripple effects throughout the economy. Social unrest grows as people lose faith in the economic system and the government's ability to manage the crisis. The situation in China appears to be reaching a critical point, with each new piece of data painting a bleaker picture than the last. It's becoming increasingly difficult to see how China can avoid a major economic catastrophe. The coming months will be crucial in determining whether the country can pull back from the brink or whether we're witnessing the early stages of an economic collapse that could reshape the global economic landscape. The Chinese banking crisis, exacerbated by the real estate market collapse, has created a perfect storm that threatens to sink the entire Chinese economy. The numbers don't lie, they tell a story of an economic superpower on the verge of an unprecedented crisis. As the situation continues to unfold, the world watches with bated breath, hoping for a miracle but preparing for the worst. The coming months and years may well determine not just the future of China's economy, but the shape of the global economic order for decades to come.